Good afternoon, and thank you for joining me on today's QuickBooks Enterprise webinar. My name is Kathryn Butts. I'm a senior consultant at Fourlane, and today I'll be discussing loan amortization. Today's topic is loan amortization, and I'll do my best to cover this complex topic as thoroughly as possible during our webinar today. We'll cover what is loan amortization, what to look for when buying a new asset and putting it on your books, some tools to create loan amortization schedules, posting your entries, and reconciling loans. To begin, what is loan amortization? An amortized loan has regular periodic payments applied to both principal and interest. This is calculated based on multiple factors: the life of the loan, the interest rate, the amount of the loan, and there is a mathematical formula that's used to calculate loan amortization, but don't worry, I'm going to give you tools for you to create your own loan amortization schedules that don't involve breaking out a calculator. When you invest in a piece of equipment and finance it, or if you take out a loan from a bank or an individual, that loan is going to come with terms. These terms help us to create our loan amortization. What is the principal? How much is the loan for? What is the interest rate? What is the length of the loan? How long do I have to pay it back? And what is my monthly payment going to be? When you buy a car or a house in your personal life, these are often the terms that you negotiate when you're making these investments. It's part of the paperwork that you sign when you acquire these new assets. These are the elements that you need to know about your loan in order to correctly book the purchase transaction and the payment transactions on your financials. And we need to keep that loan tied out and reconciled. Sometimes this is easier said than done, so let's learn how we can be successful at managing loans. When I'm reviewing clients' books, I often see a few common mistakes, and I'm going to give you the tools to correct them today. The first mistake I see is coding things like vehicle payments all to auto expense. The issue with this is that 100% of that payment is not deductible as an expense to the business. Payments against principal on loans are not a deductible expense, only the interest portion. As a result, you're overstating your expenses and artificially lowering your net income. The other thing I see is that, well, we know we aren't supposed to code those loan payments as an expense, so instead we code the whole payment to the liability account. I often also hear that you might give a year-end statement to your tax preparer, who then trues up that balance at year-end by making a journal entry to interest on 12/31. While ultimately this is correct because the balance will tie out at year-end, your monthly financials and your month-end close will not be an accurate representation of the activity on your books. This also makes your December financials skewed because 12 whole months of interest are being booked in that 1 month. An accurate month-end close includes the reconciliation of all balance sheet accounts, including loans. You might receive a monthly loan statement that you can use to reconcile to, or you might need to create an amortization schedule yourself. We'll walk through both of those circumstances together. Ideally, when you take out a loan, you'll be given monthly statements that break out the principal and interest and show the ending principal balance. And it might look something like this one. You can see on this statement, I have a payoff amount here, I have my total payment, and I have my breakout of principal and interest. With this information, you could accurately post your transaction and reconcile this loan. If you get a statement like this, then I'll show you how you can make this payment happen in QuickBooks. Let's look at this together in QuickBooks. So I'm going to pull this up, and I'm just simply going to write a check, and this loan is with BMW, and I'm going to date this on the date of the payment, which was 10/4. And you can see I've posted this transaction before, so QuickBooks kind of remembers what those accounts are going to be. I'm going to book the principal amount of that loan, which was $537.05, to the principal on the liability account here, this long-term liability. Then I'm going to split out the payment, which is $147.27 on my statement, and I'm going to do that here. So that's the principal, and that's the interest. Now, once I hit save and close here, I can pull up that balance sheet, and I'm going to drill down into that BMW Finance, and you can see that my balance is now showing $33,820.46. That is the amount that we are going to want to reconcile to here. So I can take that balance, and I can come and reconcile. I can choose my long-term liability for BMW Finance. You can see my beginning balance set up here. I've got my statement date based on the last time I reconciled. And all I really have here is this one transaction that I need to reconcile. That's the only thing that's in here. I'm going to hit reconcile now. QuickBooks asks if I want to make a payment. I don't need to do that. I'm going to hit cancel, and it's going to populate my reconciliation reports I can keep for my record. Reconciling that loan took me, I think, all of 10 seconds just now. While you might not always get a monthly statement, often there's a website you can log into that's going to give you the information that you need. You might need to poke around a little bit, but it's there. This is a screenshot from the SBA website for an SBA loan. You can see that we have on this site the payment date, we have the payment amount, the principal, and the interest amount, and I can, with this information, break out my payment. The loan balance is held on a separate screen, but this would give me the information I needed to break out the principal and interest for this SBA loan, even if they don't send me a statement every single month. Another easy to use tool that you might have access to is something like the Ford Motor Credit website. They have a great website and great reports on here with easy to access reports we can use to tie out our loan amortization. With this statement, again, we can easily pull our statement balance, our principal balance, $63,793. And then down below, we can see our payments, our principal payment of $1430.40, and our principal and our interest here. Again, if I were to come in and enter this payment, I can choose to do that with my note payable to Ford Motor Credit. And that is going to be $969.57, and my interest here for $460.83. As I record this transaction, I click save and close. And again, my next step realistically would be that I want to reconcile this account. I'm going to choose that Ford Motor Credit. I've got my statement ending date, my beginning, my ending balance I pulled right from that slide. Once I hit continue, again, all I have is that one simple transaction for my principal payment, and then I hit reconcile now. Okay. It is important to reconcile our loan accounts. When I have statements like the last two that I looked at, I know the payoff balance or the principal balance, and that is the ending balance that I use when I reconcile. Another good habit to get into, which you can always do, is to attach your documentation of that loan statement to that previous transaction that we just booked. That's an easy way to be able to kind of attach that monthly statement in there as well. There are instances, of course, where your monthly statement isn't provided, and it's up to you to generate a loan amortization schedule. I'm going to show you two free and easy to use resources to prepare a loan amortization schedule, and we'll walk through the booking of those fixed assets as well as posting of those payments. There are some easy to use tools online that we can use to create a loan amortization schedule. If you Google loan amortization, plenty of links will come up. I use this one at bankrate.com, which I find to be pretty easy to use. And Bankrate has lots of different kinds of loan amortization calculators. There are times when we might take a loan out from an individual, and that loan should have principal and interest taken out. A simple tool like this one is great to be able to book that loan. Now, let's say that this is a $25,000 loan, and I'm going to pay this back over 3 years. And I have an interest rate that's prime, which I Googled and is 7.75%. Now, typically you'd have a note agreement drafted up that would outline these terms. And as we input this information into this tool, we click calculate. And this is showing us our principal and our interest paid and our estimated payment. And if we click here to show amortization schedule, if I needed to, for example, I could adjust the start date of this loan, but this is a full loan amortization schedule. This is going to show my first payment, for example, as $780.53 with a breakout of principal $619.07. That's what's going to go to that liability line, and the interest, which hits my P&L here, of $161.46. This is a great tool, very easy to use and free, but let's look at another option that we can use to create a loan amortization schedule. We're going to use Excel, and don't panic. This isn't something that you need to create from scratch. The formulas to create this are really rather complex and a bit beyond the scope of what we can cover in a 30-minute webinar. So we're going to use some pre-loaded Excel templates. Now I'm going to come into new, and then you see this line here that says search for online templates, and I'm going to search for amortization. And I get a couple of options that pop up. And the first one that I'm going to use is this blue and white one that says simple loan calculator. I'm going to click that, and then I'm going to click create. Now with this one, I'm going to use this as an example here, and I'm going to do that same loan that we just set up in the Bankrate website. I'm going to do $25,000, 7.75%, my loan period in years, and I'll just start this today. Now you can see those are identical numbers between the Excel and the Bankrate website. And that is because they are both using that same formula behind the scenes to calculate out your principal and interest. It's easy to do that check with the total amount of interest, the monthly payment, the loan amount. I can do a quick reality check and see that those are preparing the amortization schedules the same way. Now, this is a great amortization schedule. And this is going to work in a lot of circumstances, but there are more sophisticated needs out there. So I'm going to show you a secondary template for that. So I'm going to come again to new. Again, I'm going to come in that search for online templates, and I'm going to search amortization. And I'm going to choose this kind of green and white one here that says loan amortization schedule. Now, all of these do basically the same thing, but I like this one. I think this one's easy to read, and I'm going to click create here. So let's take a look at the loan we're about to book. So this is a new vehicle purchase. We purchased a 2020 Ford Expedition. We can see kind of the terms of that loan here. So let's review those. The amount financed here, the amount of my loan is $61,687.81. The amount of my payments are $1,246.25 monthly. I've got 60 payments, so I'm paying that back over 5 years. And I've got an interest rate of 7.71% beginning on January 3rd, 2023. So all of this is the context that I need to be able to book out that loan amortization schedule, and we're getting pretty good at this by now. So let's put all of that in our new Excel file. So the first question it asks is that loan amount. Again, I'm going to enter in $61,687.81. My interest rate, 7.71. Period in years of 5. loan payments per year, and the start date of my loan, which was 1/3/2023. Okay. Now you can see here that my scheduled payment, $1246.26, is within a penny of what my payment said. I would just take that penny again against interest, by the way. And I can enter in my lender name here. In this case, let's say that it is Bank of America. So I've got all of these components here on my amortization schedule, and it's going to go all the way down and show that breakout for all 60 payments. But the reason I like this amortization schedule, it's a little bit more complex, is because it allows me to run a couple of hypotheticals. And that has to do with this optional extra payment column here. So let's say that I'm feeling pretty good with cash flow and I want to start paying this loan down a little bit faster. So theoretically, if I were to take an extra $100 and apply that to my loan payment each month, what would that difference be? Well, first of all, without that extra payment, my total interest is about $12,800, and it's going to take me 60 payments. If I enter in that $100, I'm saving about $1,200 in interest. That interest is going to decrease to about $11,600. And if we scroll to the bottom, you can see that I'm paying that off in about 55 payments. Well, that might be enticing, especially if I've got more vehicles that I think I'm going to need to buy in the future. What if I had a little bit extra cash that I wanted to do to pay down this loan? What if I added $300 a month? You can see that extra payment populates in this column here. I've got my scheduled payment, my extra payment, my total, and then a breakout of principal and interest. And this is significantly reducing that total interest and also knocking off essentially a year of payments off of my loan. So if my cash flow allows for it, I might consider paying higher than my standard monthly payment to not only pay that down faster, but to be able to save some money on interest. And this is a great tool to walk through for some what-if scenarios. Let's book the purchase of this vehicle into QuickBooks, and we're going to play a little bit further with some of these concepts of loan amortization. And we are going to come back and book this vehicle into our QuickBooks. So let's pick that up. And the first thing I need to do when setting up a new loan or setting up a new asset is to make sure that I have all of the right accounts in place on my chart of accounts. So let's come up to our chart of accounts and take a look at what we got. The first thing I need, since this is a vehicle purchase, is I need to have a place to put that fixed asset. For us, that's going to go in our vehicle fixed asset account. You can see I already have a balance here. The next thing I need is I need a place to post that loan, and I've set that up here. I've got my long-term liability note payable to Bank of America, and that is a zero balance because I haven't put any transactions in there yet. Now, in this theoretical vehicle that we're purchasing, let's say that when I went to the dealership, I put down a $5,000 deposit against the car, and then I financed the rest. So I'm going to have an initial entry here where I walked into my dealership and I went to Covert Ford and I put down that $5,000 balance. And I'm going to code that to vehicles. And I'm going to write myself a good memo here, down payment on 2020 Ford Expedition. Now, that $5,000 plus the amount of the loan that we financed is going to be the total value of that vehicle. So it'd end up being about $66,000. I'm going to hit save and close here. And now I have the opportunity to book that entry for the fixed asset and that liability. Now I can do this a couple of different ways. The easiest way for me to do that is with a journal entry. If journal entries aren't your thing, that's totally fine. I'm going to show you an alternate method today. If you double click into the register of that liability, you're going to see that you have essentially all of the same fields as you have in a journal entry. So I have a date, so 10/4/2023. Actually, that's 1/03/2023. I'm going to have the name. I'm going to be able to increase this. So I'm increasing a liability by that amount, which is that 61,687.81. And then I need to pick that account. Where am I going to offset this to? What's the other side of that transaction? And to me, that's vehicles. And of course, I want to write a memo. So purchase of 2020 Ford Expedition. Now I can do this as a journal entry, but a lot of people get real intimidated by the idea of a journal entry, so I can always use my registers for this. Now behind the scenes, QuickBooks is posting this as a journal entry, and it's doing it exactly as I'd want it to. I have a debit to my vehicle fixed asset account that's going to increase that fixed asset balance on my balance sheet, and I've got a credit in that note payable to Bank of America. So I've increased that as well, and we can see that on our balance sheet. Here's that Bank of America loan balance. When I book my payments, I'm going to break out my payments against the principal, the liability balance here, and the interest. I'm going to need to adjust that ratio of principal and interest every month according to my amortization schedule. Now, I want to take a detour for just a moment and talk about current and long-term liabilities. A current liability, in simple terms, is one that we expect to pay off in the current year, and a long-term liability is one that's going to take more than a year. If our car loan is a 5-year loan, that's a long-term liability, right? Well, yes and no. It is a long-term liability because it's going to take us 5 years to pay off, but there is another layer to this called the current portion of long-term debt. Current portion of long-term debt is the amount of long-term debt that is due to be paid within the next 12 months. This entry is typically made by allocating the expected amount of principal that will be paid in the current year to a separate other current liability account called current portion of long-term debt. This is done with the journal entry at the beginning of the year to debit the long-term liability and credit the current portion, which is a current liability account. After that, each monthly payment is allocated to the current liability as that balance is paid off in the current year. This might not be something that's necessary for your accounting system, but I wanted to cover it just in case you ever come across this. I know this seems confusing, but it's actually quite simple if you have the right tools in place. You just need to look at your loan amortization to book the entry. So let's do that now. So I'm going to pull my loan amortization schedule back up, and we're nearing the beginning of a year. So the first thing I need to identify are the payments that I'm going to make in 2025, and I'm going to highlight those in green. So this is going to be the next 12 payments that I'm going to make. The next thing I want to identify is my principal amount, and that's here in this column, and I'm going to highlight those corresponding principal payments. So my payment every month is $1246.26, but what I need to do is I need to identify how much principal I'm going to be paying off in 2025. Now, highlighting this blue column, this is going to be small on your screen, but that sums to $12,265. So if I wanted to, I could come to my books, and what I'm going to do is I'm going to make a journal entry to debit this Bank of America by $12,265, and I'm going to credit its companion account in the current liability section, which I've named Bank of America CPLDT, current portion long-term debt. I'm going to go ahead and do that as of January 1st. Okay, so I'm going to take my Bank of America, that's going to be my debit, and we're going to say record 2025 current portion of long-term debt. And then I've got that here. Again, that's my current liability, and I'm going to save and close. Now, this is not changing the total amount that I owe on this vehicle. It's just simply allocating it between long-term and current liabilities. If you were here last week for my presentation on cash flow, we talked about the difference between the operating, financing, and investing section of our statement of cash flow. A current liability is typically going to show up in my operating section of my statement of cash flow, meaning that I'm using up my kind of operating funds, my day-to-day funds. It's part of my normal operations of my business that are going to be paying down that $12,000 in 2025. The long-term portion of it remains in my balance sheet until that's fully paid off, which will happen over the next number of years. So again, I know this is a level of complexity that you may not see on your books, but it might be something if you get audited by an external financial audit, or if you have investors coming to look for your books, even if you need something like a review for a bank to take out a loan, they might want to know the difference between your current and long-term debt. So just be prepared with those terms if that's something that comes back at you again. For my monthly entries, the ongoing payments of these loans that I need to make, I can put these in multiple different ways. You've seen me write checks. I could also do an enter bill, pay bills transaction. The key here is that I want to make sure that my payments are broken out between the principal and the interest. Now, it might seem tempting to use a memorized transaction for this, but keep in mind that memorized transactions won't recalculate for the changing amounts of principal and interest for each payment. So I don't necessarily recommend the automate transaction entry for these kinds of transactions. I think it might be a better choice here to use add to my reminders list or don't remind me, as a way to save the template of the transaction with those accounts, but not accidentally have QuickBooks post the wrong principal and interest for you. So just be aware of what those memorized transactions actually do. They don't rebalance based on your amortization schedule. I also recommend, again, that you attach your documentation to these transactions. So if you are getting monthly transactions, you can attach the file. The same thing is true with our purchase transactions with those journal entries that we made. That's a great way to upload the financial purchase transaction and the loan amortization. So it's all part of your QuickBooks environment. And of course, the last piece of this puzzle, as we've seen, is to reconcile these loans. Remember in QuickBooks that almost every balance sheet account can be reconciled, including loans. While it might seem like that's a little bit of an extra step for us to go through, it is valuable to show that we have taken the care to tie that number out to our external source, whether it's a statement or a loan amortization schedule that we've prepared. And I have spoke a lot today about vehicle loans because that's a common purchase for so many of my clients. But this concept applies to all different kinds of loans. Loans from individuals, equipment loans, perhaps a new piece of landscaping equipment or a forklift. It might be a mortgage on a property or an SBA or a bank loan. All loans fit into this model regardless of type. So as long as you understand the major components that you're looking for, you should be able to find a tool to help you keep that amortization in check and to keep your books on track. While it might seem like this is a lot to manage, fixed assets and keeping an eye on our loan payments are essential to cash flow management and having an accurate balance sheet. The more attention to detail we pay in our ongoing accounting, the fewer year-end adjustments we have to make that might skew our reporting throughout the year. Thank you for joining me on today's webinar. I appreciate your time and attention, and I hope this brought some clarity to booking loans and loan payments on your books. Thank you.